All right, let's get into it. Finding solid, steady income for your portfolio these days well, it feels like a real hunt, doesn't it? It's pushing a lot of us to look at some of the more complex stuff out there. And today, we're diving headfirst into one of those corners. This is the question on every income investor's mind, right? The old standbys, the traditional places you'd go for yield, they're just not cutting it anymore. So what do you do? Where do you turn when you need that cash flow? That's the problem we're going to unpack right now. For a lot of people, the answer, or at least a potential answer, lies in these three letters: CLO, a collateralized loan obligation. Now, I know that sounds incredibly intimidating. It's a mouthful. But stick with me here, because by the end of this, you're going to get what it is and exactly how it works. To really wrap our heads around this, we've got to see how a CLO is actually put together from scratch. We're going to take this really complex financial machine and break it down into simple, easy-to-understand pieces. Block by block, it all boils down to these three basic steps. First, you've got a CLO manager who goes out and gathers up hundreds of different corporate loans. We're usually talking about loans to companies that are considered below investment grade. Second, they take that whole bundle of loans and place it into a special legal structure, kind of like a trust. And then third, and this is the key part, that trust issues brand new securities, but it slices them up into different layers. In the finance world, they call these tranches. Okay, so the CLO is built, but how does the actual money, the interest payments from all those loans, make its way to the investors? This right here is where the really unique and, sometimes complicated magic of a CLO really happens. The whole system, the entire thing, is built on one simple concept: seniority. It's basically a pecking order. When the cash from all those loan payments comes into the CLO, it flows down through the structure in a very specific order. They call it a cash flow waterfall. And here's what that waterfall looks like. At the very, very top, you have the AA-rated tranche. Now, it's the safest because it gets paid first, no matter what. So, because it's the lowest risk, it also has the lowest yield. Then in the middle, you have what are called the mezzanine tranches. Think of these as a blend: medium risk, medium yield. And then way down at the bottom, you have the equity tranche. It gets paid dead last, which makes it the absolute riskiest piece, but it also has the potential for the highest reward. But this is the million-dollar question, isn't it? The structure looks pretty clever when all the companies are paying their bills. But what's it designed to do when things go wrong? When the companies in that loan pool actually start to default? The pain starts at the bottom and works its way up. That equity tranche we just talked about, it's specifically designed to be the first line of defense. It absorbs the first wave of any losses from defaults. This creates this protective buffer. It's called subordination for all the other layers above it. The mezzanine tranches, they only feel the pain after the equity piece is completely wiped out. And that senior AAA tranche is the most protected of them all.
Okay, so now that we've got the mechanics down, let's zoom out. Let's look at the big picture. Because like any investment on the planet, CLOs come with a pretty distinct set of pros and cons.
And you can see it laid out here pretty clearly. On the benefit side, you've got things like enhanced yield, often higher than other types of bonds, and protection if interest rates are rising since the loans are floating rate. But then you look at the downsides. They are incredibly complex. They can be really hard to sell in a panic, which is liquidity risk. And your returns really depend on the skill of the manager running the show. But look, to really understand an investment, you have to go beyond the textbook definition. You have to ask the tough questions about how it actually behaves in the real world, especially under stress. So let's dig into 5 critical questions that get to a much deeper truth about CLOs. Here's the first one. Let's imagine a scenario. The loans inside the CLO are doing fine. Defaults are super low, but the entire market is freaking out. There's a liquidity crunch, meaning way more sellers than buyers. What happens to the price of that safest AAA tranche? The answer might totally surprise you. In the market chaos of March 2020, even with almost no actual credit losses, the prices of AAA CLO tranches dropped by 5, sometimes 10% in just a few weeks. Now, this wasn't because the loans were going bad. It was pure market mechanics, forced selling, and just a total lack of buyers in what's called a dislocated market.
Prices got disconnected from the real value. And that leads us to our second, and honestly, maybe the most important question of all. You see AAA on a CLO and you think, okay, that's just like a AAA-rated government bond. But are they really the same kind of risk-free?
No, not even close. They're fundamentally different animals. A government bond is backed by the full faith in credit, the taxing power of a government. Its main risk is just that interest rates will change. A CLO AAA, on the other hand, is only backed by its clever structure and the cash flowing from a pool of corporate loans. Its main risk is something called credit spread widening, which is just a fancy way of saying the market gets scared and demands a higher yield for taking on corporate risk. Question 3 brings the manager back into focus. See, most CLOs have what's called a reinvestment period, maybe 3 to 5 years, where the manager can actively trade loans in and out of the portfolio. So how does that affect things?
Well, it's a classic double-edged sword. A really sharp manager can use this time to their advantage. They can sell off loans from companies that look like they're weakening and actually improve the quality of the whole pool. But on the other hand, a manager who's feeling the pressure might be tempted to reach for yield. That means buying riskier loans just to keep those payment numbers looking high, which could make the whole thing a lot more dangerous down the road. Okay, so we said that floating rate feature is a benefit when rates are going up, but you have to look at the other side of that coin. What happens to the income from a CLO when the Fed starts cutting rates aggressively? Well, the income just drops. Simple as that. Because the payments from all those underlying loans are tied to benchmark rates. When those rates fall, so do the cash flows coming into the CLO. And that can cause CLOs to really underperform other kinds of bonds when you're in a rate-cutting cycle.
And for our final question, how well do they actually diversify a portfolio? Let's say you own stocks, you own corporate bonds. If you add a CLO, does it really save you when a big credit crisis hits?
The answer is it's a little nuanced. Look, they have a low correlation to stocks, which is great, but they have a much higher correlation to other credit assets. What that means is, during a broad credit panic, the fear factor for CLOs tends to rise right alongside the fear factor for corporate bonds. So, they can help for sure, but they are not a perfect, magical diversifier. So, putting this all together, how can an investor get access to just one specific part of this complex machine? Well, these days there are ETFs that let you do exactly that. This fund here, for example, is designed to invest only in that top AAA-rated slice of the CLO stack. It's a strategy that tries to isolate what should be the most secure piece of this whole structure we've been talking about. And that leaves us with the final and really the most personal question of all, a question for you. CLOs can definitely offer some attractive income, but that income comes at the cost of some serious complexity and some very unique risks. So the question every investor has to ask is this: for my goals, for my portfolio, where do I draw that line?